Hi, and welcome to Better System Trader Live. Glad you could join us today, where we're going to be talking about strategy optimization. So let's get to it. Well, hello, good morning, good afternoon, good evening, wherever you are. Welcome to BST Live. Glad you could join us today. We're going to be talking about strategy optimization. And, I think some of the things that we're going to share today, or our special guest is going to share today, could be very interesting, may even shock you. So let's get to it. So our special guest today is John Ehlers. And you may well know John as from his work in digital signal processing, DSP in trading, and also he's done a lot of cycles work in trading. So he is the founder of the Mesa, which you've probably heard a lot about. He's the author of multiple books, I think four or five. He's also a contributing editor to Stocks and Commodities magazine. He's won numerous awards for his work. Welcome, John Ehlers.
Hi, Andrew. Thank you for having me today.
It's great to have you here. I noticed in the news the last couple of weeks there's been some fires, huge fires over in California. And I remember when I visited you a couple of years ago, your house is set in some beautiful bushland. So I was hoping you haven't been affected by those bushfires at all, have you?
Oh, those fires are just awful. They've consumed 4 million acres here in California this year. The closest one to me personally was up in Big Sur, about 30 miles away. The fire didn't affect us, but the smoke was really, really bad and the ash fallout. You've had fires out there in Australia, so you know a little bit about that yourself.
Yeah, that's right. But 4 million acres, I mean, that's huge. That's hard to even comprehend the amount of fire that is. So 30 miles from you, it's relatively close, right, considering the magnitude of it all?
Yeah, it makes you think about it, that's for sure.
Yeah, absolutely. Well, it's great that you're here. And today we're going to be talking about strategy optimization. And as I said at the start, I think some of the things that you're going to share today might surprise a few people. So I can't wait to get to that stuff. But first, how about we start with a few of the basics? So can you explain a little bit about what strategy optimization is and why traders think it's important for their trading strategies?
Sure. First of all, optimization is a misnomer. You're not optimizing anything. When you optimize a strategy, you're simply finding the combination of tunable parameters that produce the best historical profits. Doesn't say anything about what's going to happen in the future necessarily. So nothing is optimized. You're just finding a parameter combination that works or has worked in the past.
Yeah, right. I think that's the funny point that you mentioned there is a misnomer, and I think we're going to probably dig into that a little bit later. So you talked about they're selecting the right or parameter set, perhaps that will work in the future. How do you go about selecting which is the best, or which is the best, I should say, because there are a number of different metrics you can use to decide that. So what do you personally do?
Well, first of all, you have to think of optimization as a statistical project, and so you have all of these combinations that you're working through to find the best one. So if you think in terms of probability, and you have 100,000 combinations of parameters, the probability of having that one parameter set that you found works best work into the future is 1 in 100,000. So that's a low probability of success. What I found in using TradeStation's optimizer in the genetic mode was that it would seek near the optimum or the maximum fast in the optimization process. That is, and the implication is that the probability distribution of all the parameter combinations was not uniform or even Gaussian. So what you were trying to do is to get the combination of parameters having the highest probability near the one that produced the most profit.
Yeah.
So that in a nutshell is how you would seek to find the optimum set. You find something that in the genetic mode seeks an early solution.
Yeah. Yeah, I remember actually you mentioned that a few years ago at one of your workshops. I think you were pretty early on in that observation where you were doing optimizations using excuse me, genetic algorithms, and you said that the speed of convergence or finding the solution could actually directly impact the robustness. But I remember at that time you were still doing a lot of work on it. So has your opinion changed? I mean, you did just mention it there, but did you find any additional research from doing that?
Well, there's a couple aspects of that. First of all, if you look at the results of the genetic optimization and rank the results in terms of the profit that you made over your selected span of history, you're going to get a curve that goes from maximum to minimum. And that curve that has the least slope across all the range of parameters is the one that is the most robust. And kind of a figure of merit is look at the 50% point, halfway down the curve. How far off of the maximum result are you? So another thing you can look at is statistically, if you're at the 50% point and you're using those parameters over a relatively large length of time in the history, over a similar large period of time in the future, that those statistics will tend to hold that you're going to make at least 50% of the profit that was available from a maximum. So you're looking at not necessarily trying to get the best, highest historical solution. You're trying to get the best slope across all the range of parameters.
Yeah. And obviously as well, there are a couple of factors that can actually impact the results, like parameter ranges and the how refined you are with those potential values across the range. But Al has just raised a good... Oh, sorry, did you want to comment about that before I ask a bit further?
Sure.
Yeah.
I think the quick answer is the fewer parameters you have, the fewer combinations you have. And so the Murphy's law prevails. If anything can go wrong, it will. And so if you have a parameter set that works adversely, it's going to happen sometime in the future. So think of optimization of two parameters this way. Parameter X and parameter Y produce profitability in the Z direction. So you have a lumpy kind of plane, and generally want to find not a mountain or a peak in that range, but you want to think of the optimum results as kind of a mound, and you want to be in that mound area. That's where the highest probability is. But if you have more than two parameters, you got to think in terms of an n-dimensional fuzzball or lumpy fuzzball. And that was my picture that I'm. And so I've tried lots of different things. For example, I tried to find the best lump in the ball by integrating over an area, that is, integrate over an area of combination of parameters over the surface of this n-dimensional ball. And that was a surprising failure. The upshot of it is that I conclude that the mental picture of the combination of these parameters that you have, it's not a fuzzball or a lumpy fuzzball. It's more like a prickly pear cactus leaf. That is, the correct solutions are little spikes, and they're really hard to find. And there's a lot of loss areas or bad areas in between the spikes. And so the true answer is to reduce the number of tunable parameters to an absolute minimum to make a robust strategy.
Yeah. Yep. We've got a couple of good questions here in the chat. If I can just share them with you now. Since we're talking about genetic optimization a little bit, here's one from LinkedIn Doctor. I'm going to put it up on the screen. One sec here. When you use genetic optimization, do you also take into account those combinations of parameters that lose money that are neighbors of those who win money? So that's kind of what you were talking about there with the spiky result, I guess.
Yes, that's the lumpy fuzzball approach. I did try to integrate over an area, and that really didn't work very well at all, frankly.
Yeah. Okay. All right. We've got another question here from Al regarding genetic optimization. Let me just put it on the screen here. Do you favor fewer generations and a larger starting population when using genetic algorithms?
Actually, my approach is a little different. I want to see all the combinations in my results. So I set my number of tests that are saved to 2,000. The default setting in TradeStation is 200. So I increase the number of settings to 2,000. Then when I do a genetic optimization, I tend to leave the number of samples in each generation at 100. That's a randomization. And then I reduce the number of generations to about 40, because the combination of 40 generations and 100, I forget what they call them.
Populations? Is it populations, I think?
Population, yeah.
Yep.
Gives you possible 4,000, but the genetic doesn't run through all those combinations. So you end up with less than 2,000 typically. So that's generally my procedure. I do want to see all of the combinations. If the combinations exceed 2,000, then I either decrease the number of generations, or I go back into TradeStation, increase the number of samples that are saved. Mm-hmm. There's an upper limit on that. I think it's around 4,000.
Yeah, I think so as well. Yeah. And one more question here. We've got one from Jones. Let me just put it on the screen. Jones would like to know, what is the best objective or fitness function to optimize? John, you mentioned profit, but this does not take into account maximum drawdown.
There are several that work really well. The bottom line is net profit works as good as anything. The TradeStation fitness function works pretty good. Also, a perfect profit correlation works pretty good. When you're optimizing over a wide range of considerations, there's other things to take into consideration, though. That, for example, you can get a really high amount of profit if you overtrade, that if you get a large number of trades. So you have to watch the number of trades and the profit per trade as part of the optimization process, or you can go off the deep end and get a solution that might be historically most profitable, but one that's not really tradable.
Yeah. All right. Thanks, John.
You don't want to trade. Yeah, you don't want to trade 5 or 6 times a day, for example.
Yep. Well, that kind of leads nicely into reoptimization frequency. Now, we had a bit of a discussion before today about this, and I found your insights interesting, and I haven't tested them out myself, but I'm sure that people will find this interesting as well. So, how often do you reoptimize, and why?
I'm going to have to take a step back, and I'm going to get a bit theoretical on you.
Okay.
So people can kind of look this up. First of all, market data is fractal, and that means the spectral density increases Well, it's noise with memory, or pink noise. That's the character of the structure of the data. Given that, that's a fact. You can look that one up. Given that, you can make a model of the market structure as white noise filtered through an exponential moving average. That exponential moving average provides the noise with memory part. And it has memory. So, given that you can create a synthetic data stream just with the white noise generator, a random number generator, and an exponential moving average of it. And when you get that exponential moving average fitted correctly, you're going to get the alpha of the exponential moving average. And that alpha you can relate to the length of a simple moving average. 2 over the length of a simple moving average is equal to the alpha approximately. And so now you have the time constant of the data memory in terms of length of a filter. And that's typically when you do that, and it's in terms of numbers of bars, it's going to be something on the order of 100 bars or less, maybe more, plus or minus, I'll say 100 bars plus or minus. So that's a time constant that the data is giving you. So you have to interact your walk in terms of walk forward optimization or periodicity of re-optimizing the step size, as it were, in terms of that minimum time constant. See, the problem is when you do re-optimization, you have to have enough trades in your memory or in your test to make a statistical judgment that you've got a good set of parameters. On the other hand, you can't use too much data or the old data is just obsolete. It's outside its time constant. So with all that arm waving about theory, what I do is I use 2 weeks on intraday, I trade 15-minute bars, use 2 weeks of history and trade 1 day at a time. So at the end of every day, I'll re-optimize for the last 2 weeks, and I'll use those parameters for the next day or the next 27 bars. There's 27 bars in a day session of the S&P.
Yeah. Or
daily, it works a little differently, and yet you have to take into account how often you want to trade and what you try to take what the market is going to give you. So I like in daily data, I hold a position 2 to 3 weeks. So my step size on re-optimization is a month, just because you can remember that. And I looked about 6 months back. So I get 10 or 12 trades in history and 1 or 2 trades in using each new set of parameters. So that's kind of the scale factor for re-optimization.
Okay. Yeah, when you told me that, I thought that was quite interesting because, there's a couple of different schools of thought around this. And one of them is that you want to include a lot of data because then you can get different market conditions and come up with a better result of average, I guess it means. But your approach really is more tuned to the current market conditions, right?
Well, I have a feeling about that also. Yes, you need to look at a lot of data. If I'm looking at daily data, when I'm designing a system, I look back to 2000, January 1 of 2000. Seriously, over the last 20 years. If I'm looking at intraday data on 15-minute bars, I'm looking back to the beginning of 2017. And so I expect my strategy, when I optimize over that length of time, to perform well. That is, it has an acceptable equity curve. And having said that, equity curve is the last thing you want to look at, to evaluate a trading strategy. But what we're looking for is a trade-off. You have to trade off the statistics, long-term statistics, against the short-term performance. And the only way that you can do that is to use all this history and your strategy, even though you're retuning it, has to work acceptably, I'll say, over a long span of tests, maybe 1,000 tests, 1,000 trades rather.
Yeah. What I probably should have rephrased my previous question, because I was talking about the re-optimization window. So the amount of data you actually use when you're doing a re-optimization. So I think what you said is intraday you use a 2-week window, and then daily you use monthly. Is that right? Or did I misinterpret that?
I use a 1-day step size and an intraday, right. 1-day step size and a 2-week history window.
Right. Okay.
On daily, I use 1 month step size,
right.
6-month look back.
Yep. Okay.
But
so
it's trade. I understand the positions, and it's simply a trade-off. And I've given you my rationale for using those step sizes. It's all based on the time constant of the data that's there, and the frequency of your trades. I like to trade once a day, maybe once every other day on intraday, because that's the duration of trade that gives me a nice profit per trade based upon the cycle amplitude.
Right. Okay. Yeah. So then if you do the math, so you're looking at a 2-week data window and you're trading every day, that gives you 10 trades. If my math is correct. Yes, it is. That's right. But, people will say, well, statistically, that's not enough, right? It needs to be 30 or 50 or 100 or whatever people think is a good value. How do you balance that then? Are you saying it doesn't matter?
Oh, I'm glad you asked. Now you throw the problem to the machine, and you make that process programmable. So now it's called walk forward optimization, and so you automate that whole thing and put together that 1 day at a time profitability, and now you can see the history of your trading process, but it's done without a sample results. So it's trading exactly as you would have traded if you were trading it in real time.
Okay.
So it's a walk forward optimizer. One thing I'm going to be discussing in my upcoming workshop is my walk forward optimizer algorithm, which I think is really it's blazingly fast. So you can almost use it as a real strategy. Typically, the walk forward optimizers in the platforms and others take forever to run. And that's one of their downfalls. They take so long to run, you kind of lose interest in the project by the time you get an answer.
Yeah.
Not to mention that I'll say I just don't trust the built-in walk forward optimizers. I don't know what they're doing, and they don't produce the same kind of results that I produce out of code that I write myself. So something's going on that I don't like. So I don't use built-in walk forward optimizers.
Yeah. I've also found using some platform walk forward optimizers, sometimes the results are a little bit like, how did that come about? It doesn't make any sense. So, I think you need to probably check your results.
For example, in TradeStation, you have no way of knowing if you're doing intraday optimization. You have no knowledge of when the trading optimization period starts during the day and when it ends. And a lot of my rules depend upon time of day.
Okay. Yeah, I could see how that would be a problem. Now, you've actually you've given us the rationale behind how often you re-optimize and the length of the data window based on the theory that you shared. What do the numbers say? Have you actually tested different periods and lengths just to see if it backs up the theory or not?
Oh, absolutely.
Yeah.
I've written my optimizers so I could vary both the step size and the look back period. I've got to say, it reinforces my opinion of my theory that there is a time constant in the data. So if your look back period gets too big, your results fall apart.
Yep. Okay. And you did mention in one of those comments there, cycles. And I think in the past you've mentioned that there's a monthly cycle in the indexes, but I don't know if it's just a coincidence that you've got 14 days re-optimization, which is half the cycle length. But what about other markets that aren't the indexes? Have you tried in, I don't know, like metals and things like that? Does the theory hold true there as well?
Sure. Metals are kind of tough, frankly, particularly gold. But I've tried it on soybeans and the meats, cattle and live hogs. Works well on bonds. So treasury bonds are a good vehicle as well. And there's a plethora of indexes that you can trade now. And even for the guy that has a small capitalization, he can trade the micros, micro NQ or micro ES. So there's a whole wide range of things to trade. I prefer ES. There's enough going on there that I don't have to look too far.
Yeah. We've got a question in the chat from Jones again. And I know the answer to this, so it's probably a good time to talk about this one. The optimizer let me put it up on the screen. The optimizer that John is alluding to, is it an add-on to TradeStation? Do you want to talk about that a bit more, John?
No, it is not an add-on. It's built in easy language, however, and I fully disclose it in my workshop. But the algorithm, I'll even tell you what the algorithm is. It's straightforward. I first of all compute the indicators I'm going to use in invoking my strategy rules. So I store those in arrays. The next, I take the look back period and use those arrays to calculate the profit in the look back period. And from that, one that gives the best profit gives me the best set of combination of parameters to use tomorrow. And then for the next 27 bars in the third section of the optimizer, I trade that set of parameters for the next following day. It's that simple. But that's because I don't store vast amounts of data. I only store the indicators I'm going to use, and then I calculated everything on the fly. So it works pretty fast, actually. It is written specifically for some of my own strategies, but it's in a template form. So if you have your own indicators or your own strategies, you can apply the template pretty easily. But it's in easy language.
Yeah, I'm really interested to check out this idea myself. I typically re-optimize my strategies yearly just because it's easy. But I'm hearing that you go right down to daily re-optimization. It's like, wow, I've got to try to define a resolution and see what happens. So that's gone up to my very long list of things to test. I'm interested to see what the results are.
It's not that much work. If you're day trading and you just at the end of the day you run process, you can do it manually on your strategy. So you do an optimization at the end of the day using the last 2 weeks of data and use that for tomorrow. That's all there is to it.
Yeah.
The beauty of the walk forward optimizer is you get to see what the effects of that are historically. That is, you can see your
Yeah.
historical results.
Yeah. Yeah. Now we've got a question in the chat here that almost feels like a setup, but it's not. Asking about the workshop, that was my next question, because I know you've got the workshop coming up soon. And maybe Al wants to know if you considered offering the workshop online. So how about you just take a minute to talk about the workshop and let people know what it is and when it's running and stuff like that.
Well, you've been to my workshop a couple
I
of
have.
times. I used to have it here in Cambrian, California.
Mm-hmm.
But this year, there's a little thing called COVID-19 going on. And so travel is just almost out of the question.
Yeah.
And even if you got travel solved, there's a problem of having people in a meeting room. So this year, I'm conducting the workshop. It'll be a virtual workshop on WebEx. It's going to start at 1:30 in the afternoon Pacific time. That is 15 minutes after the day session of the futures close. And it'll run for 4 hours a day, starting a week from tomorrow, Monday afternoon at 1:30 to 5:30. And it'll go for 4 days in a row. I've got 16 different 1-hour modules. So I cover mathematics in one, and data in another, and indicators in another, and so on. And then Friday would be a 4-hour open mic Friday. So we'll just have that will be the time for the discussions. I'll try to answer questions at the end of each module.
Yeah.
But the format almost forces me into a lecture kind of format.
Yep. Okay. So 4 hours a day after the markets close. From what date was it? Sorry, I didn't hear you say. What date does it start?
The 19th of October. Right. It's almost upon us. The 19th of October is the start, a week from tomorrow.
Yep. Okay. And to find out more details, I've actually set up a link so that it's easy for people to find. And bettersystemtrader.com/JE workshop 2020. So I'll put that in the show notes so that people can find it. So I think that's all the questions about the workshop. We've got another question about, actually, John, before we finish, before we move on, is this I think you told me the other day, this is your last workshop. Is that right? You're going into full retirement, full fishing mode. Is this the last one ever?
That's the plan. Yeah, I'm an old guy, as you can tell. And so my plan is to hang up my shingle and take it easy from here on. Yeah. I really, really enjoy doing these workshops because, it's kind of the modern equivalent of a book. It gives me enough time to develop the theory and the technology and pass it on, and like you would if you were reading a book. It's no problem to write a magazine article, which is basically a research report. But writing a real book, takes a year. It's really hard work, and you arm wrestling with the editors and on and on and on. But that's a year that you're not doing research. And I've been doing research up until just last week, and so the people that come to the workshop will see almost immediate results of what's been going on. I've got some really neat theory stuff about the structure of noise in the market. I found out it's really fascinating stuff.
Yep. Okay.
But it's theoretical. It doesn't help you a whole lot in trading, but it's kind of nice theoretical.
Yep. Okay.
On the other hand, what the theory does do for you, it keeps you from going down the wrong path. You just don't go there because it's fruitless. And so you can save yourself a lot of time on experimentation if you kind of follow the rules of the theory.
Yep. And as I mentioned, I've been, last 3 or 4 years, I think, and you always share more of your recent research, so it's always interesting to see all the new stuff that you share. So I'm looking forward to that one. I'll be attending as well. It's perfect for me. It's morning
Well,
for me.
for example, here's something that's really neat. In the process of working on walk forward optimization, I found that I was getting different results because I was using infinite impulse response filters like an EMA.
Mm.
And every time you step the data, you get a different result with an EMA because the starting point is different. So that forced me to look at finite impulse response filters. And then I did a little research on that. And lo and behold, um, those have some interesting characteristics that should be carried forward into the walk forward optimization, because you're using just a finite amount of time in history. So um, if you use EMAs, for example, an MACD kind of indicator, you got problems with a step forward because you're going to get the different answer every time you step the data.
Yep. That's funny you mentioned that, because I was having a chat with Al, who's on the chat here today, and Adam, and they realised this as well. It depends where you start when you're using EMAs as to what results you get. So I think you've just explained why.
Yeah, I think that's a hot lick I've discovered in my research. So I've found ways to manipulate FIR filters to be, highly advantageous.
Okay. All right. Let's. We've got a couple more questions in the chat here, John. So we might do a few of those, and then we'll start wrapping up. So we've got another one from LinkedIn Doctor. By the way, I think LinkedIn Doctor is a new. Sorry, I'm just trying to click this on the send. Here we go. It's new because I haven't seen the name before. So welcome, LinkedIn Doctor. What benchmark do you use to compare and evaluate a trading system?
That's a different question we've talked about before. Now we get into figures of merit. The basic idea is just like gaming. There's only two parameters that really count. One is profit factor. That profit factor is the ratio of gross wins to gross losses, and the other is percent wins. Just like gaming, those are the two that count. Now, there are several figures of merit that involve those, like average win to average loss, et cetera, et cetera. Almost every one of the standard figures of merit emphasize profit factor as the dominant criteria. Personally, I prefer to emphasize percent wins. And so my figure of merit when I'm comparing strategy A against strategy B, I look at the following: the quantity of 2 times the percent wins minus 1, closed quantity, times profit factor. So at 50% wins, 0.5, you've got the answer is 0. And if you go below 50% wins, even though you have a large profit factor, you've got a negative figure of merit. So it emphasizes percent wins comparing A against B. So that's my preferred figure of merit, comparing two different strategies.
Is that just a personal preference, or is there some theory or logic behind that?
I simply gave it to you. I want to emphasize percent wins.
You just prefer to have a higher win rate?
The real answer is there's only two things that count: profit factor, percent wins. Now you can you can take a product of the two, and that would be a figure of merit. I prefer multiplying percent wins by 2 and subtracting 1 from that product, because that makes it percent wins start at 50-50 and really penalizes you. You can have profitable systems that have less than 50% wins. If the profit factor is big enough, you have more winnings than losings, but you have fewer of them. So it's a trade-off, and that's my figure of merit, because I like it bothers me a lot to have 3 or 4 or 5 losers in a row.
Yeah.
It starts to become psychological,
Mm.
even though I know statistically that's going to happen.
Yeah. Okay, that's fair enough. I've got a question here from Ola. Ola joins us every week, so welcome back, Ola. I'd love to hear your view on optimization of position size.
I don't optimize position size. I make a decision on positions. And that depends on who you are and your capitalization, frankly.
Mm.
Um, um, uh, I think that I can best describe it. I call the cowboy, the one that is fairly risky approach.
Yep.
Take the average, your historical average loss, multiply that by a number of acceptable losses, like 10 losses in a row. So now your average loss times the number of acceptable losses plus the initial margin if you're trading, we're talking about futures. So that divided into your total capital is the number of contracts to trade.
Mm.
And I call that the cowboy. If you want to have a relatively conservative point of view, I can get into the statistics of the Rayleigh distribution of drawdown, but the upshot is that you have less than a 5% probability of exceeding twice your average drawdown. So
Right.
if you divide twice your average drawdown into your capitalization, that's the number of contracts to trade.
Mm. Okay. And I was also thinking, in one of the podcast guests a few years ago, we were talking about exits, and I don't remember who it was, but they said they don't like to optimize exits because it increases the chance of curve fitting. So do you look at exits separately when you're doing optimization? Do you not optimize them at all, or how do you feel about optimizing exits?
I trade long and short.
Yeah.
So an exit of a long position is a short position entry.
All right.
So the answer is I don't look at exits.
Okay. That's fair enough. All right. Well, I don't see any more questions in the chat. So if there is no more questions, then I think we can start wrapping up. So thanks for your time today, John. It's really interesting. It's always good to chat to you. And you've given me some insights into and some more ideas to test for optimization and some position sizing stuff in there, which you just mentioned, which I'm going to check out as well. So that was very good. Thank you very much. Now, just on next. Oh, sorry, what was that?
I said, thank you very much.
Okay. No problem. So if I can just mention, next week we have special guest is Bob Pardo. We're actually going to be talking about the rise of robot trading and the use of artificial intelligence and other technologies in trading. And I know he has some views which I think are going to ruffle some feathers. So I'm looking forward to that one next week. And that's going to be at the normal time, 7 p.m. Central. So make sure you join us for that one. I think you're going to like that. So if you enjoyed today and want to show your support, please hit the like button on this video. And if you haven't subscribed, don't forget to subscribe and hit the little bell icon to make sure you get notified whenever we release new content. So thanks again, John. Actually, sorry, one more thing. So that workshop link for people who want to get more details, bettersystemtrader.com/JE, so John Ehlers, JE Workshop 2020. And you can get more details and we might see you there. I'll be there. So, and John will be there. So be good to, I've just noticed Alex is here and he has a question. So go ahead, Alex, if you have a question, you've got like 5 seconds. to type it in before we move on. So I know Alex has come to a lot of your workshops too, John. So he's got a very advanced understanding of your work, DSP and cycles. So we'll give him 5 more seconds to type his question in. No pressure, Alex. Was there anything you wanted to finish up with, John, before we go?
Well, I would like to encourage people to come to the workshop. It's going to be the last opportunity to share my technology. I think I have a unique view of the market. I look at it as an engineer would look at it, not as a traditional chartist. And so my view is unique and I think beneficial. And so doing it again. So time is running out.
Yeah. Okay, so a question from Alex, and then we're going to finish this up. I have a friend who considers that a non-station time series is titled as... Oh, he's missed the last part of his question. So we'll let him type that. So I just want to share some feedback, John, because we've got a lot of thanks from people here. So LinkedIn Doctor said, thank you very much, Mr. Ehlers. Jose says, thanks. G'day, Jose. Scouse US. I don't know how to say that. Thanks, John and Andrew. So, and one final question from Alex. I think he's finished typing that. I have a friend. Let me see if I can do this. Is over 2 messages, so I don't know if this is going to work. The first part is, I have a friend who considers that a non-station time series is titled as continuous stochastic transverse waveform. What are your thoughts on that? Wow.
I don't even know what that means. Stochastic means it's random. Transverse means it's sideways. And for sure, data is non-stationary. That is, it's noise-like, and the pattern that's there never repeats ever again. So I'm not exactly sure what that means. I've not run across that description.
Well, I'm sure Alex is getting to attend the workshop because he has every year. So maybe he can save that one for thinking about it a little bit more. So thanks again, John. We're going to finish up now. I'm conscious of the time. So thank you, everybody who also attended and provided questions and comments. One final one from Al who said, fantastic. So thanks again, John. Thanks for everyone for attending and have a great week. Cheers.